Do you do a lot of podcasts?
Yeah, I have my own podcast.
Really?
Yeah, I do it. Yeah, it's called "How Can I Be Helpful?" It's a tongue-in-cheek. It's kind of like a snarky title about how unhelpful most venture capitalists are.
And you're one of them?
We hope to be different. Yeah, no, podcasts are fun. They're great. It's when you get a dog, you become a podcast fan.
Yeah.
Because you have so many hours that you have to fill, particularly in the winter. It's nice to walk around in the summer with your dog, but in New York City, particularly on the west side of Manhattan, you get 30, 40 mile an hour wind gusts. Podcast is the only thing you have to keep you warm.
Yeah. Do you do it like on Zoom calls, or is it in person like this where you're sitting with cameras around?
So almost all of them we taped on a specific platform called Riverside.
Okay.
It's actually way better. Obviously, you guys have hacked the setup here where everybody has their own mic. We taped one where there was one of these in between me and the person I was interviewing, and it was a total audio disaster.
Well, in person? Y'all do them in person, though?
Typically, no. Typically, a lot of the guests are from California or wherever, so we usually do them remote.
What was the reason to start that show?
Honestly, I just couldn't find any podcasts I wanted to listen to because I think we're operating in a very narrow slice. There's obviously a lot of big, broad, tech industry-wide podcasts.
Yeah.
What I was looking for was something a little more narrow around people who are doing venture capital in a really serious way. Mm-hmm. And I think, look, I love the industry. Obviously, I chose to make my career in it, but I don't know how many venture capitalists are doing it in a unromantic, serious, almost maniacal way like we are, and we wanted to get to know the other people that were doing it that way and help them tell their stories.
What's one thing that like someone who's doing it in a romantic way, like one telltale sign that they're doing that?
Yeah, there are a lot. Look, I think a lot of people meet charismatic founders whose companies are growing quickly and they want to invest. And we see that as table stakes. We obviously don't invest in boring people or companies that might grow slowly. I think the delta is a lot of VCs confuse revenue growth and large revenue TAM with sustainable enterprise value creation. And VC returns come from enterprise value creation, not revenue growth. So AI right now, great example, tremendous amount of revenue growth in AI, tremendous amount of enterprise value growth in AI. Query how much of that is truly sustainable enterprise value growth, or once we get to the saturation point, a lot of that sort of revenue growth actually goes away, or it proves to be kind of unstrategic and it gets competed down. At the firm I used to work at, Bain Capital, we had this expression that eventually all businesses fail. And if you think about it, if you look at kind of how much the S&P 500 changes over, I think there was some recent stat, in 20 years, half the S&P 500 changed over. And those are companies that have gotten to tens, if not hundreds of billions of dollars of revenue. So if companies like that can fail, companies that have 50 or 100 of ARR can also fail.
How do you make your venture firm, Asymmetric Capital, not fail?
It's a great question. I mean, I think, look, every 92 or every 93 days, once a quarter, we get together and think about everything we did in the prior quarter, how it panned out relative to what we expected, which portfolio companies performed well, which companies raised capital, what percentage of new deals that we wanted to win, did we win? And we're constantly trying to kind of out-innovate and disrupt ourselves, because the worst thing you can do, I think, is set a strategy and never deviate from it, because the market context is constantly changing.
Yeah. Speaking of, I want to go back to the podcast for a second. How do you get guests? Do you hit up your group chats, your VC group chats, founder group chats, and say, dude, come on the show?
I think we made maybe 12 or 14 episodes. It was all people that I found really interesting. Mm-hmm. And ordinarily the way that somebody ended up on the podcast was I would have a lunch, dinner, coffee, whatever with them and say, God, it'd be really great to have you on the podcast. I want this conversation to be one that's kind of memorialized on the internet forever.
Speaking of venture capital group chats, today's November 6th, 2024. Donald Trump has just been announced the presidential winner. What are the group chats like this morning in the VC space?
Not as active as I would have thought. Obviously, government has some impact. In reality, great companies are going to be formed under Democrats and Republicans. Great companies are going to be formed under, all sorts of government regimes. The thing that surprised me was there wasn't more conversation about Elon Musk. So we have somebody who's a top one or top one character in American tech right now get so involved in a political election in which it would seem to me that he has pretty good upside associated with having backed the winner. Yeah. SpaceX, Tesla. I think one of the most interesting tweets I saw was somebody tweeted that Biden not inviting Elon to the 2021 electric vehicle summit was one of the great unforced errors in American policy history. And, my hope for the new administration, or I guess the new old administration, is that this can be an era in which technology is very much seen as the solution to problems, where I think for a lot of the last 4 or 8 or 12 years, technology in the U.S. has been seen as the problem.
Yeah.
And certainly the large platform companies haven't done themselves any favors at all with respect to social media and all of the above. But, the United States has some real challenges right now globally.
Yeah.
And technology companies, I think, can be an unbelievable factor in solving those. And so my hope is that having America's, top technologists be so close with the president can hopefully have downstream impacts for energy and for sort of supply chain independence and a lot of other things that I think are really important right now.
We saw the S&P up how much this morning?
It was about like 100 points this morning.
100 points. So I would think that most of venture capital leans left, at least outwardly. Do you think that venture capitalists, despite what they may have voted for in this election, do you think that they're maybe secretly happy this morning that Trump won?
Yeah, I think there's a nuance. Forgetting what venture capitalists think politically about their own beliefs, one of the things that I think not enough people have realized is that that mergers or acquisitions have been almost impossible for the last 4 years. So you have Lena Khan, essentially running the FTC. In my opinion, one of the worst federally elected officials in the history of America.
Wow.
I studied industry and regulation undergrad and wrote my thesis with a gentleman that had really written the federal merger guidelines. And the reality is that very few markets are going to have anti-competitive effects. So if Delta wanted to buy American Airlines, that would be very bad for consumers because you have an industry there that has natural monopoly, huge barriers to entry. Delta and American or Delta and United compete directly on many routes. So 3 sort of scaled players, maybe 5 with JetBlue and Southwest, 3 or 5 becoming 2 or 3 really, really bad. But there's so many markets where the government has intervened in M&A of late that make no sense because consumer pricing is hardly likely to move at all. And there's this analysis, which is kind of the relative market share in the industry as defined. What's the relevant industry? So if you think about it, if you sell ice cream cones on West 4th Street and you have another vendor on West 5th Street, those are reasonably, competitive. But an ice cream vendor on our street and some ice cream vendor in Brooklyn, nobody's deciding whether to get an ice cream cone here or in Brooklyn. Yeah. I think with the what her team and department have done a lot lately have blocked mergers between people selling ice cream cones in Brooklyn and people selling them, in the Village, almost out of a sense of just all mergers are per se anti-competitive. And the reality is a lot of the venture capital industry derives a lot of its returns from strategic M&A. And particularly in software where there's virtually no barrier to entry and anybody can start a new player in a SaaS space and there's very little natural monopoly. To think that sort of any merger activity in software should be rejected, I think is kind of crazy. And we certainly saw with Adobe and Figma deal being held up for so long. That was a bad thing for the venture industry. And I also think a SEC that is far more focused on IPOs being able to happen and happen more seamlessly. Look, the reality is obviously there's a huge backlog of companies that are private that should be public right now.
Yeah,
there are many reasons for that. Among them are the SEC rules, and I would hope. And we know, look, the current SEC guidelines largely came out of Enron in the mid 2000s, and a lot of what the SEC does is really positive for investors. But at the same time, I think the SEC policies, particularly as relates to investing in private funds, have some very some effects that are very much unintended consequences. So a lot of the best returns available in private markets come from, or a lot of the best returns in financial markets come from investing in private markets. Sophisticated investors, endowments, high net worth can invest in certain asset classes. Your average person on the street cannot. Of course, it is far better to not have people losing all of their money, but you can lose all of your money in the stock market, right? And so I don't think there's a huge difference between letting individuals that don't meet whatever kind of net worth or income standard invest in private companies. It's almost systematically unfair to derive that and very kind of paternalistic.
Last year we talked about so much. Is the IPO window opening? Is it closing? Do you feel like now that Trump is in office or will be in office soon, the IPO window will open up again?
So, look, I think one of the biggest implications of the election is a M&A antitrust framework that probably is more conducive to allowing tech companies to get acquired. Certainly, I think we saw with Adobe and Figma and a lot of other cases that mergers are being blocked right now for undoubtedly well-intentioned reasons on the government side that are making it very difficult for companies that have scaled that would potentially combine with other companies in their space have no downstream impact on consumer prices. Those companies are really struggling to get to exits, and I think it's a really good thing for our industry to have kind of strategic M&A come back.
Early stage startups, though, like we see M&A and IPOs, but for an early stage startup, how are those affected by the election, if any?
Yeah, I wouldn't think the election has too much impact on early stage startups. Look, at the end of the day, great companies are founded in all market environments. The most important judge of whether a early stage startup is going to scale well is whether it finds product market fit, whether it's systematically creating value for its customers. I tend to think I get a lot of questions from reporters, or what do you think about this interest rate change or this, geopolitical development? Surely if you are a business that has a direct, implication from interest rates or the war in Ukraine, critical. Yeah. But the reality is the average sort of domestic business serving domestic customers can do that in any market environment. So I don't think it'll have too much impact for better or for worse.
Yeah.
So on the team side, look, we are trying to back founders with a proven track record of creating value in company context, largely private, sometimes in public. A lot of VC firms try to back second-time founders. Surely having started a company prior is good background for starting a company now. We tend to think that second-time founders are somewhat of a hype bubble. Surely you learn a lot of lessons starting a company. I learned a lot of lessons starting a company and scaling it. We think it can be just as effective to having been a person who scaled a new product within a larger company, or was the one who found that key feature that maybe scaled that business. I don't know if you guys know Kyle Harrison, but he wrote a fantastic piece the other day about kind of performative failure.
Contrary?
Contrary, yeah. To me, raising $250,000 or $1 million, never finding product market fit, running a company for a year or two is interesting, and it's certainly better than having worked at McKinsey during that period. But that to me is not as much maybe a badge of courage or a green flag as I think the rest of our industry sees. I generally have a preference for founders that have found a way to make things succeed, even if they weren't the founder necessarily. Maybe they were the CTO, or they were the first head of sales, or even the first sales rep.
Josiah and I we were founders of Demo Day. This is our first time being entrepreneurial, really, and we're venture backed. We have no background in being a startup or scaling a product. How can we stick out to a VC if we want to raise a seed round?
Look, we're trying to back companies that are relevant, credible, and differentiated, that do something that is different from what other people offer. It is a credible delivery. So if I told you, I could drive you to Queens after this, you'd probably say, that seems pretty credible. If I told you I could take you to the moon, that's maybe not so credible. But unfortunately, me driving you to Queens is not differentiated at all, because you could take the subway, you could take an Uber, you could walk. Where VCs get uniquely excited, obviously you have to love the person. That's table stakes. And you have to believe that this is an offer that other people in the market are going to have a hard time replicating. And we pass on wonderful founders all the time, particularly in AI, that are doing something that lots of other people can do. If we meet somebody, they've gotten out to an early start, but somebody else with 6 weeks and a little bit of funding can replicate what they're doing, that's not a business that's going to have sustainable enterprise value.
What's something that you hear in a pitch that makes you two-sided, that makes you kind of cringe, makes you say, I've heard this one before, I don't love this line.
Yep.
And then what's one that you hear that you go, oh, this person's the real deal, and I'm more interested.
I gotta write a check.
The biggest red flag for me, obviously there's lots of real red flags, but design partners I just despise. To me, there are customers that can pay money for the thing you built, and then there's everybody else. Mm-hmm. And if you want to call something a design partner because it's an early beta customer that maybe has preferential economics or is partnered with the company in some special way, that's fantastic. But when people have unpaid design partners and believe that that's kind of evidentiary proof of traction, that hardly ever works. The green flag side, one of our first investors, we were lucky at Catalent. We had Highland and General Catalyst and Greylock and Mark Cuban and Salesforce Ventures, just Scott Cook, the founder of Intuit, just wonderful investors. The thing that one of them said to me all the time was, what have you learned about your customer segment this month, this quarter, and how have you changed what you do as a result? And so founders who have that testing hypothesis orientation, I think, are very likely to succeed. And I think that trait is actually more important than sort of grit and tenacity, because the downside, grit and tenacity are obviously great traits. The challenge with grit and tenacity is that it can lead you to just bang your head against the brick wall over and over. And typically that doesn't actually advance the story. What advances the story is finding a way to go over or around or beneath the brick wall.
Can you go through that story of cold emailing Mark Cuban and having him on as an investor?
Yeah, of course. So, we got the business started in business school. We very quickly got to a fair amount of revenue.
And you could share the business as
yeah,
well.
so the business originally was called hourlynerd.com. We subsequently rebranded to Catalent Technologies. Came up with the business plan in my business school apartment. We went out to California. We met with 27 venture capital firms. They all said no. One angel, a wonderful man named Bob Doris, said that he would fund us and he'd give us a couple $100,000. But in order to close that round, we needed to get one person to invest that was not our family or friends, like a real investor. And we spent that whole summer of 2013 trying to fundraise. Couldn't find anybody to invest. And then my co-founder decided that we should apply to go on Shark Tank. So we applied. We got accepted. Wow. We ultimately were not able to make the taping because it conflicted with the beginning of second year of business school. And so we were all sort of down in the dumps because now we wouldn't be able to close our seed round. And he suggested that we should email Mark Cuban directly. So found his email, which you can also find online. Sent him what I thought was a very earnest note about our process of turning down the Shark Tank invitation. And he wrote back almost immediately saying he loved the idea and, committed to invest. And and that was how our first round got funded.
Wow, that's crazy. Without meeting y'all, just over.
No, we didn't. We subsequently met him down the road. But, I think people like Mark have the ability when they see something that, to my point, is relevant, credible, and differentiated, they can peel away from a lot of the noise that you typically see, at the associate level of what was MRR last month or what language is the product written in. As you get deeper in your investing career and you're a partner at a VC firm or obviously one of the top angels in the US, you can think conceptually about the business and whether it has kind of independent staying power.
Yeah. Thousands of people, if not tens of thousands of people, email Mark Cuban every day, I would think. So what did you put in your email? Like, how did you subject line, or what did you write that you think caught his attention?
It was a great question. Maybe you can ask him. The subject line was investment opportunity, hourly nerd marketplace for independent business consultants. Look, my emails and visits on podcasts and video interviews tend to be just content bombs. And I think sometimes founders, you surely don't want to have a badly formatted deck, and you surely don't want to have typos in your email. I think substantive people respond really well to substance. And some of our industry and some of every industry is very much focused on presentation and style. And we at this firm are just focused at both Catalent and Asymmetric on just how can we just relentlessly create value for the customer. At Catalent, that customer now is Fortune 50 companies like Pfizer and Anheuser-Busch, InBev. And at Asymmetric, we really think of the customer as our limited partners. We collaborate with founders, and we love working with them. But at the end of the day, we are in business to create returns for our limited partners. And we prosecute that strategy by backing world-class entrepreneurs.
Wow. I was going to ask how long the email was, because I've in our business, like if we send a long email to an investor like, hey, come on our show, we almost never get a response.
If I send like a one-line email being like, hey, come on the show, this is who we've had on, they're like, down, and then that's
it was probably 3 or 4 paragraphs. I think the more important thing that I found from Mark and the Kraft family, who are also wonderful people, and Jeff Immelt at GE and Scott Cook at Intuit, really world-class people respond to cold emails. The people who don't respond to your emails are kind of the marketing VP at a CPG company who thinks that they're really cool. in my experience, almost every wildly successful person I've emailed has written back. And I think it's because they have the clarity of judgment to understand that some fraction of cold emails inbound are a good use of their time. Surely 95 to 98% of them are not.
Yeah.
And I think folks earlier in their careers, or perhaps with less embedded self-confidence, apply the heuristic of every cold email is going to be a waste of my time.
Those 27 no's you got from VCs in Silicon Valley, how did that influence you or shape you as a founder moving forward?
I've probably been through a handful of phases thinking about that week. It was all in 1 week, so it was sort of 4 to 5 no's every single day. Sand Hill Road, coming from New York, you think, we have a meeting at 2900, then at 3300 Sand Hill Road. Those got to be right next to each other. And that's true in some of the little mini office parks there, but some of them are a half mile walk. So we just got dropped by, I don't even think it was an Uber. I guess it was 2013. So we got dropped by an Uber at the beginning of Sand Hill Road with the day of meetings, but we were kind of running, and some of those you have to cut through the woods. I think at first it was kind of like the stages of grief. At first I was indignant and shocked that people wouldn't want to back a whippersnapper from Goldman Sachs and Bain Capital. I think over time I understood where they were coming from, even if I disagreed, and obviously Catalan's been successful. As a venture capitalist now, I'm not sure I would have backed myself. If you think about all of the building blocks, surely the company was a great idea, but when you look at the team and no tech, very low scale in terms of actual results. The reality is it was a round more appropriate for angels. And I actually think embedded in that round is the strategy of Asymmetric, which is that Asymmetric invests not typically at the stage where VCs invest, which is at $1 million or $2 million of top line, but we invest where angels typically invest. And we do that because once other VCs are investing, all of the competitive advantage is gone, but we can compete, we think, pretty well against angels. So almost everything we do here on the traditional venture side is pre-revenue, pre-seed investing.
Talk to me about the conventional methods, conventional outcomes behind you. It sounds like you're kind of alluding to that a little bit.
I'm very proud of that sign. I think I made it for $10 or $12 on Etsy. I have no idea what the artist thought they were making. But look, there are some really high-quality VC firms in the world. Sequoia, Benchmark, Bessemer, Greylock, Andreessen, Excel, Index, General Catalyst. You can either try to do what they do worse, or you can go do something entirely different. The emerging managers I just simply can't understand are the people who have exactly the strategy as the branded firms, but don't have a brand. Mm-hmm. And, we're in a space here where brand matters so much. So when my colleagues and I looked at the competitive advantage, sources of competitive advantage in the industry, it was very clear that brand was a big one. There are others. You can have subject matter expertise. You can be particularly compelling to work with. But we said we need to invest before other people think is wise, which means largely doing pre-revenue investing. We need to have a playbook that allows us to find deals long before other VCs are talking to those people. So most of the people we back, we get to know through our existing founders 3, 6, 12, 24 months before they're going to found. And we are spending time with them and developing their ideas and maybe giving them a term sheet even before they've left their current company. That's what we do on the traditional venture side. And then credit to my partner, Sam, who landed on this market segment. We also do cash flow positive buy and build strategies, but at the micro scale. So roll-ups is a hallmark of mid-market private equity investing and has been for 30 or 40 years. What's more difficult is doing $500,000, $1 million EBITDA roll-ups. And we think that there's still really good competitive advantage there, that you can buy companies for 4, 5, 6 times instead of 8, 10, 12 times. And you might be thinking, well, if everybody knows that you can buy companies for about half what you can buy them when they're twice the size, why doesn't everybody do it? The reality of our industry is that managing small amounts of money is not particularly fun from a AUM and a management fees perspective. Okay. If given the choice of running a $105 million fund that becomes a $125 million fund or a $600 million fund, why would you ever do the former? Our orientation is everything we do is with the goal of making 5 times net to our limited partners. We don't care about AUM. We don't care about management fees. We don't care about vanity metrics. We don't care about, whatever list of blank number of people under blank age. All we want to do is find great companies, invest in them at relatively early valuations, make them capital efficient and sell them at high prices. And it reduces a lot of the complexity that people have in this asset class where they're thinking about prestige and notoriety and fee gathering or AUM gathering in support of fees, all we're doing is optimizing for returns because we think that's what our customer wants. And by the way, we can't work with the biggest pension funds in the world, and we can't work with, by and large, sovereign wealth funds because they need to write 100, 200, $500 million checks. We work with the most sophisticated family offices and institutions that want to write $5 to $25 million checks and do it only with premium returns.
I'd love to hear more about this playbook that you mentioned for how you meet with founders before, 12 months before they're meeting with any other VC firms. What is that playbook to get that?
Well, look, I think the thing we do most broadly is we just treat the definition of a founder very differently. So for most other firms, a founder is somebody that has launched a company.
Yeah.
For us, a potential founder is somebody that we think has high merit, that has shown some amount of entrepreneurial intent. We largely get connected to them through our existing founders that represent 70, 80% of our deal flow.
Wow.
And then we do this kind of crazy playbook of being normal people and spending time with them. And there's no, it's not contrived in any way. It's not like we're taking them through whiteboarding exercises. We do an offsite with our existing founders in Jackson Hole in January, and we have a lot of teams out to Nantucket in August for board meetings. And we very often encourage our founders to bring their former colleagues, their college roommates, their childhood friends along and form very, I think, authentic relationships with those people where if they're going to stay at Palantir or OpenAI for the rest of their careers, we're happy to make them an advisor partner and have them maybe consult with our companies. And we'd also love to back them if they want to start something. And where the magic happens is as they go through their company discovery process, we can partner with them on that journey and be a sounding board.
Wow.
And ordinarily the outcome of that process is if we like them and we like the idea, we'd love to give you your first $1 million, $2 million, $3 million.
That's very cool. Is there anything you do specifically on that trip with these people who may never even thought about starting a company that you kind of say to them or do with them that sparks that imagination for them of like, oh, wow, maybe I should start a company? Is there some presentation you give?
Yeah, see, that's the thing. We always joke that certainly in the Jackson Hole event, there is no content. The content, obviously, we hope that everybody wants to ski or snowshoe or do other things outside because it's obviously a beautiful place. But we thought for a while about maybe we have panels or we have, existing founder talk about how they scaled some growth challenge and maybe that sparked something for somebody. I think we found that the simplest and best human relationships are based on joint love of skiing and food and beautiful places. And we hope that relationships happen organically. We think it almost would be contrived for us to have a session, in a hotel ballroom where it was kind of, once a conference becomes a conference, it's not fun when it's just great people spending time with other great people. My favorite thing that I see develop every year, and I think I'm interesting and the rest of the folks at Asymmetric are interesting, the nights always begin at the restaurant with asymmetric people blended with the founders, and by the end of the night, all the founders are talking to each other, and we're sort of off to the side. Yeah. And that's largely our goal. Like the VCs are not the heroes of the entrepreneurial journey. We are a part of the ecosystem, and we help. But having been a founder myself, founders are the heroes of the journey, and we kind of want to get the right people in the room and then step aside.
Earlier, you talked about the importance of brand growth. How are you growing your brand right now?
I might put that in the category of kind of authenticity is really the only thing that matters. I have so much respect for VCs that write blog posts and are on all the lists. And I was about to say have podcasts, but I guess I kind of have a podcast. We have the strong belief that retail interactions matter so much more than wholesale interactions in this space. So if you spend 3 or 4 hours with us at a dinner, you're going to become a lifelong promoter. If you read a listicle about 8 tricks to growing your B2B SaaS business, you're probably not going to have much of a sustained impression of us. And it happens to play to our strengths where I think all 6 of us are really kind, open, transparent, optimistic people. And we also really hate writing bullshit blog articles. And so there's happy alignment in a very people-driven go-to-market. And how that comes back to our firm strategy, we're not trying to do hundreds of deals a year. We're not trying to do dozen deals a year. We want each person on our investment team probably doing 1 to 4 deals a year. Okay. And if somebody on our team did 2 or 3, I'd be thrilled. And if you roll that into our strategy, let's say we have a $125 million fund. We have 4 check writers on the team. That's $30 million that each person has to invest over a 4-year period, including follow-ons and reserves. So that's $7.5 million of kind of company investment created per year. that probably is one or two investments. And that can allow us to work at this very low scale, unscalable model where we are forming real authentic relationships with probably each of us 40 or 50 people a year, which I think is in the bounds of, you can form one new relationship a week that is serious and earnest and authentic. And if it's only half a new relationship a week, that's good too. You only have to back one or two of those people a year. Yeah. And every year that adds to your install base. And obviously on day one of the firm, we all probably had 500 or 600 people we knew we'd back. And it's a very simple program there, all because we don't care about increasing our AUM or increasing our fund size. All we want to do is find one or two good deals per investment professional per year.
And does that seem to carry over well once you actually invest in a founder and they become part of the portfolio? Do you feel like that relationship continues very well with Asymmetric, maybe better than other VC firms, that founders really feel like they have a venture capitalist who's in their corner more than at another firm?
Yeah, I mean, this is probably our biggest point of differentiation with the rest of the industry. Most people write checks, and the meme of our industry would be the best companies you never have to talk to. We probably agree with that. There's another 40 to 80% of the companies you back that actually do need a lot of help. And we talk to them every single week. We are not just pontificating, but we are opening Microsoft Office or Google Suite as appropriate, and we are in models with them. We are rewriting PowerPoint decks. We are interviewing salespeople. We are coaching salespeople. There's a general kind of hyperactivity and mania of this firm, which is that a lot of VCs, God bless them, spend time making market maps and getting coffee with other VCs and writing kind of listicles, or doing outbound sourcing, which we also don't really do. We take all of that time and deploy it in our existing portfolio companies. And we found that, one, it makes the companies better. Two, it helps us understand when they're going to need reinvestment and how we can plan for that. And then most happily for our overall process, that is what typically leads to them wanting to refer in other founders.
If a founder or potential founder is watching this right now and they want to get involved with what y'all have going on at Asymmetric, how can they get in touch with you, or how can they connect with you to go to a dinner or something like that?
So probably the best path would be to get to know one of our existing founders and have that existing founder come to believe that that person is, a high quality, entrepreneurial, serious person, and have the introduction come through that. We obviously get thousands of inbound leads all the time. I think what we find is the anchoring context of, I built a company in a similar space to this, or I came from a company in a similar space to this. This has unique merit. It's worth 30 or 60 minutes of your time. What I can say in response is your first meeting will be with the check writer, and that's definitionally true because everybody's a check writer. There's a very high chance they'll have a partner in the meeting. And if what you're doing is potentially interesting, we will take you through a streamlined process, particularly at the pre-revenue point, where we spend 100% of the time focused on what is the chance of this becoming a 1, 2, 10, $20 billion company, and 0 on what are you going to spend on pencils. I think that was my biggest frustration as a founder was, for pre-revenue rounds, people would ask these incredibly detailed questions. They'd have reams of data lists, and I've kind of realized that those are just not very good firms. And the firms we were lucky to work with, Highland, General Catalyst, Greylock, really saw and understood the big picture of what we were trying to do, and everything was oriented around that.
Yeah. Before we close, Rob, it's getting close to the end of the year. What's a big goal you have for Asymmetric in 2025?
I wish I could say I had some kind of 2025-centric milestone, but we just want to go out and find another 6 to 12 great founders. We have a bunch of companies that raised wonderful rounds, follow-on rounds from the likes of Co2 and Founders Fund, from Andreessen, from General Catalyst, from Box Group. We just want all of our companies to continue executing well, and it's not as if we have kind of full calendar year goals. We have quarterly goals for each portfolio company. So, if I had my dream world, we backed 29 companies in Fund 1 over a 3-year period. They're all still alive, which is kind of unbelievable. I would say I'd love for all 29 companies to still be alive at the end of 2025. I would love, we sold one company relatively quickly and had amazing return, partnered with great founders there. I'd love to see another 1 or 2 companies sell in 2025, and we'd love to partner with, 6 to 10 great new founders.
Awesome. Rob, we really appreciate you being on the show today, man. Thank you.
My pleasure. Great to be on.
Thank you.